Do you ever feel like no matter how hard you try, it's still impossible to find ways to save money? Hi, my name is Gio. Hope you're doing well. In today's episode, I'm gonna show you 8 simple steps to start saving money. Let's get started. Saving and budgeting can seem stressful at first, but having a fixed goal and follow a few simple steps can actually be really easy. It can help you visualize an exciting future in which you have bought your first car, first house, have a nice investment portfolio, a nice vacation, or even started a family. While you may not have control over the economy, you do have control over the actions that you take. So here are 8 simple steps on how to boost your bank balance quickly. Step number 1. Learn to budget and understand your finances. My most important tip for saving money fast is pretty simple. Learn to budget. If you are in control of your budget, you are in control of your finances. What is a budget? It's a plan for every dollar you have. It's not magic, but it represents more financial freedom and a life with much less stress. Here is how to set it up. Calculate your monthly income, pick a budgeting method, and monitor your progress. When it comes to a budget, take-home income is the only income that matters. Forget about the pre-tax earnings. Your take-home pay is what you can spend and save beyond what you may already be putting into a retirement account at work. When calculating income, also include other sources like Social Security, disability, pension, child support, regular interest, or dividend earnings. Any money that you regularly receive can be considered income for your monthly budget. Your budget should outline how your expenses measure up to your income, so you can plan your spendings and limit overspending. Try the 50-30-20 rule as a simple budget framework. In it, you spend roughly 50% of your after-tax dollar on necessities like groceries, houses, basic utilities, transportation, insurance, and minimum loan payment. Anything beyond the minimum goes into the saving and debt repayment. No more than 30% on wants, even if it's difficult to separate wants from needs. In general, needs are essential for you to live and work, and wants include dinner out, gifts, travel, and entertainment. At least 20% on savings and debt repayment. The 50-30-20 allocation may also need to be adjusted from time to time to account for emergencies or unexpected expenses such as roof repair or a big medical bill. Tip number 2, get out of debt. Before you start saving, you'll likely want to pay off any outstanding balance on your existing debt. The longer you delay paying off a debt, the larger it becomes. That's because interest, the price you pay for borrowing money, continues to increase over time. If you put off paying your debts, the interest can wipe out any money you manage to save up. Financial experts often recommend 2 ways to manage your debt: the avalanche method and the snowball method. Both plans may help you focus your effort to paying down your debt. An avalanche approach means you pay off your loan or credit card with the highest interest rates first. You throw as much money as you can at them and pay only the minimum on all your other loans. The snowball approach has you pay the lowest amount of debt first, pay it off, and then move to the next one. Tip number 3, find ways you cut your spending. If like many people, you often have too much money at the end of the money, it's natural to think about getting a better job or a side hustle. But the real problem may not be how much you make, but how much you spend. You may need to reduce expenses, maybe drastically. Here are some ideas for cutting everyday expenses. Use resources such as community event listings to find free or low-cost events to reduce entertainment spending. Cancel subscription and membership you don't use, especially if they renew automatically. Commit to eating out only once a month and try places that are not that expensive. When tempted by a non-essential purchase, wait a few days. You may be glad you passed or ready to save up for it. Tip number 4, set saving goals. Setting specific saving goals will help you to begin saving money. When you are just putting money into bank on a regular basis, it can be easier to withdraw it for various reasons. You can easily overspend and use some of the money you have saved. For this reason, it is important to save for a specific target or goal. You may be working on several objectives at once, Or you may be focused on one specific goal that you want to meet. If you are saving for retirement or your child's education, consider putting that money into an investment account. While investment comes with a risk and can lose money, they also create the opportunity for growth when the market grows, and could be a right choice if you plan for events far in advance. Tip number 5, decide on your priorities. It is common to receive advice to put money into savings, but many people do not know where to go from there. It is important that the money you have saved has a specific purpose, so you can find the best way to make that money grow and begin building wealth. Understanding the purpose of each kind of savings and investment along with the best timing of each can help you know how to prioritize as you begin to put money away. Few examples of savings and investment priorities: retirement, life and health insurance, emergency fund, long-term wealth goal, or short-term goal. Tip number 6, pick the right tool. Once you determine how much money is appropriate for your savings fund, you must determine which saving tools to place the money in. Saving tools are secure and liquid accounts offered by depository institutions that assist in the management of a saving fund. The 5 most common type of saving tools are checking account, saving account, money market depository account, certificates of deposit, and savings bond. Different savings tools can be used to assist an individual reaching personal financial goals. Tip number 7, make savings automatic. An automatic saving plan is quite simple. You schedule a recurring deposit from your checking account into linked saving account. How often the deposit occurs depends largely on how often you are paid and your personal preferences. For example, if you paid weekly on Friday, you could schedule an automatic deposit the following Tuesday. That gives your paycheck enough time to clear, or if you are paid once per month, you could arrange for a saving deposit to occur automatically along the same time frame. The timing isn't necessarily what's important with an automatic saving plan. It's the consistency of it that counts. Tip number 8, watch your saving grow. Review your budget and check your progress every month. Not only will this help you stick to your personal saving plan, but it also helps you identify and fix problems quickly. Understanding how to save money may even inspire you to find more ways to save and hit your goals faster. The bottom line is, you don't need any fancy degree or special background to become an expert at managing your finances. If you use these 8 simple financial tips for your life, then you can be as personally prosperous as someone with a hard-earned MBA in finance. Let me know in the comments what is your strategy for saving. Thank you so much for watching. If you like the content, please consider to like, subscribe to my channel, and if you're planning to open an account on any exchange platform, you can use my referral code in the description down below. See you in the next video.